Welcome back to Squawk. Yesterday, AMC was once again one of the most actively traded stocks. For more on the meme mania and the frenzy it's creating in the equity markets, we are joined by Amy Wu Silverman, head of derivatives strategy at RBC Capital Markets, also Craig Branch, managing partner at Veritas Financial Group. Good morning to both of you. Amy, what do we make of this? What do we make of the apes?
Well, they're back. And look, they're not just trading AMC stock. They don't just like the stock. They really, really like the options. We look at some of the stats from last week. Over 10 million AMC contracts traded, something like $1 trillion in premium. And when you actually break that down, more than 50% of that is what we would characterize as small lot trades. So trades that are, 10, 11 option contracts, those are retail sizes.
So what percentage of this is retail? In your mind, what percentage of this is driven by retail? What percentage of this is driven by institutions trying to play retail?
Yeah, it's over half is retail, because those are basically based on the small lot sizes. And then, the rest is institutional and obviously people now who get the playbook, who've seen this movie and are chasing that momentum.
And just one final point on that. When you say 50% institutional, 50% retail, is that options or equity or both in your mind?
That's in options. That's in contract sizes that we can deduce based on their sizing, whether it is, a block, a large options trade, or a retail trade, which is kind of 10, 11 contract sizes.
So, Greg, is this a short squeeze or is this something else?
This is not a short squeeze. And quite frankly, we do ourselves a disservice when we say it is only a meme-driven phenomena. I like to call it a meme and theme-driven phenomena. And so when you look at the activity in the meme stocks, of course, we're seeing that be heavily retail. But also, when you look at every theme that has seen a pronounced spike over the last year, first starting with a reopen trade, then starting with growth, then starting with ESG and the electric vehicles, all of that has been retail driven. When you look at the names that have driven those themes, the data points out that about 50% in those most pronounced names was retail activity. And so this is not a short squeeze. And if you had asked me a year ago, I would have said, stay away from these names that are heavily retail involved. Now professional managers have to make this a part of their formula. We have to take into account the impact that the retail
hold on. So how are you trading? So if you're taking this into your calculus, how would you trade GameStop? And let's also define, are we trading GameStop or are we investing in GameStop?
Right. I'd like to think of myself as more of the latter, as an investor. And what I think for professional investors, this is causing us to have a much more net long position than we otherwise would have. You have to think twice about shorting stocks in this environment because sometimes the movement is fully divorced from any fundamental analysis. GameStop is trading at about 9 times the enterprise value we saw for it in 2017. Even if you believe a full recovery to pre-pandemic levels, and you can make an argument that a post-pandemic peak is going to be lower than that, given shortened theatrical windows, given inflationary pressures, a 9 times valuation increase is reserved for companies that have some fundamental change, some positive catalyst that we can identify and describe. That's not what's happened here. It is at 9 times its value pre-2017. And so there's no fundamental case you can make for that. And so for me, it just means that I'm staying away from shorting or being net negative on names that I previously would have thought to do.
But just to be clear, Greg, you're not going long these names or temporarily long these names just to play them or to ride them.
No, that's not the strategy we employ at my firm. I'm sure that there are people who can capitalize on that, short-term movements. But for us, we are only long names where we can make a fundamental long-term case for, and you can't do that here.
Amy, how does the music stop?
Yeah, look, when you look to other peak periods of this kind of exuberance, so call it August of 2020 last year, January of this year, a lot of it comes with potentially an options expiration and just the die down of momentum. Volatility is a mean reverting asset. You can't sustainably be at 500 to 1,000 implied volatilities. People are buying options that suggest AMC is going to move anywhere from 30 to 60% per day. That's not sustainable. And we are already seeing people, on the institutional side, essentially play for that die down in volatility. And I think those triggers will eventually maybe not bring it back to earth, because frankly, GameStop's not back to earth, but definitely kind of lower from the levels we see right now.
Amy and Greg, I want to thank you both. It's wild. It's wild. There's nothing else to say about it.
Shepard Smith here. Thanks for watching CNBC on YouTube.